Welcome guys once again. In today's video we'll be talking about market structure. What is market structure? When we talk of market structure, we are looking at the nature of the market. The way the market is structured or the way the market behaves. So we'll be looking closely at volatility indices. So in the previous videos, we have spoken about the states of the market, and we mentioned the top 3 states of the market. I could have said the top 3 states of the structure of the market. That the market is either trending or ranging, or it moves in a channel. Okay, so in volatility indices, most of the time the markets are trending. The market is very volatile, and most of the time the state of the market that we have there is in a trending state. The conditions are trending 90% of the time, and sometimes yes they do range, but majority of the time they are trending or in a channel. So if you don't know what a channel is or a range, go and watch the first video. Okay, so if you are interested in trading volatility indices, you can find them in Deriv. So the market structure that we are talking about, the trending market structure, looks something like this. We say a trending market is a market that is creating higher highs and higher lows, or is creating lower lows and higher lows. Okay, so when it's in an uptrend, the market will tend to do something like this: pull back, go up, pull back. So when it pulls back, this is the nature of the market. The market will always tend to come back to the previous high. Okay, so this is the first high. So the market will come back here and bounce off from that high, breaks the above high, creating a low here. So this is a high, this is a low, this is a higher low, and this is a higher high. I got it. So the market has made a high and a low, then the market broke this high to make a higher high that is higher than the previous high, and the market pulled back to this previous high to retest it and went up to break a higher high, okay, creating a higher low. So in this state, the market is trending upwards, okay, creating a series of higher highs and higher lows. So this is an uptrend. Okay, so now, but when we look into in the markets, it's not as easy as it is right now. It's not like the market is just going to make a high, 10 here, create a higher high, come and test this one, and go on and so forth. So when you look at the live markets, you will find that the market will tend to move something like this. Okay, so this here, so this is market structure. This is the foundation of the structure, making a series of highs and lows. Market made a high, another high, another high, a low, a low, a low. So the market makes a series of higher highs and lower lows, and it keeps on breaking them and retesting them. That is the behavior. It impulses, pulls back, impulse, pull back, impulse, pull back, impulse. That is the nature of the market. Okay, but in the live markets, the structure will be more like this. Okay, so it's gonna do exactly the same thing, but with a twist. So I know in most videos, like, people will be teaching you that the market is just making higher highs and higher lows, but when you get to the market, you can't really see where is the high and where is the low. Okay, because the market will pull back, break structure, and we know once the structure has been broken here, when we say break structure, we mean that the market has broken a high or a low. So in this case, the market broke structure above. It means that it has broken this high. So when it comes back, it may do something like this. And then it goes up. You see, it didn't just come straight down. So if this is a higher time frame, when you go to a lower time frame, you realize that this movement here coming to test the structure that was broken, it might be another trending market. Okay, so what you want to do is always to mark the high that was broken, and you wait until the market reaches to that high before you make your entry. So when you get to that high that was broken before, you wait to see a candlestick pattern, and then you make your entry. Okay, then the market came to break structure here again, creating a higher high. Okay, so the market may do something like this again, and you start creating some type of a range. Sorry about that. And then comes back to retest the area and then go. So it's still making pullbacks, going up, pull back, going up, pull back. But the pullback are confusing because within those pullback you have highs and lows as well. You know, so what you need to mark is the high that was broken, which was right here. Okay, so the market was broken at this point, and then we are expecting a pullback because the nature of the market is a impulse, pullback, impulse. Okay, so you can say impulse, correction, impulse, just like that. So that is the way the market moves. That is the market, the nature of the market, the behavior of the market. It tends to do that. It goes high, it impulses, pulls back, impulses, pulls back, impulses, pulls back. So the key is to be able to identify the highs or the lows that were broken. So you don't have to look at all this noise. You just wait for the market to come to the high that was broken. Okay, so some people will come, you see the market has broken this higher high here, and then it created some sort of a range, you know. So when you come into the market, you see that the market broke out of the range, then you start entering your sales here, then you'll be caught out because the market is simply going back to a high that it broke to test it. So you must wait to see the market react here, Because if you entered here at the break of this range here, this is some type of a range right here. So the market was ranging here, but it's still a pullback. So you must be patient enough to wait for the market to come back to your high that was broken. Or some people will call it, or it's a faker. The market faked or something, you know. But the market was simply going back to test an area. And then it shot above. Same thing in a downtrend. The market will pull down, pull back, pull up, break structure here, come back, retest structure, and go up. Okay, so we have a low here, and a lower high. So this is in a downtrend. So it will behave exactly the same. In a real market, it will be something like this. Break structure, and then when it's coming back to retest the structure, it might do something like this, and then it shoots up. So you must be patient enough to enter where the low was broken. You don't enter at the top, you wait for it to come here. So you only make your entries at key areas. So this is what volatility indices do. Very easy. So I want us to have a look at the charts now. Let's look at volatility 10. Okay, it's called V10. So we're going to have a look at it and study its market structure and see if it's going to behave the same way I've been explaining here. Let's look at the charts.